I have not done like.
Yes. Uh, uh, Sylvia, can you maybe, yeah. Okay. Good.
Don't forget to. Yes. John. Yeah.
Check, 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 check. Yes. we start. Can you please have a seat, ladies and gentlemen? Yeah, ladies and gentlemen, we would like to start. We have already some delay. Thanks for coming and sitting. Apologize, Apero starts in 2 hours. You still need to wait a bit. So I'm Marc-André, I'm the president of the Swiss Association of MBAs. I'm very happy to be here with you, and we have already something to share. Is someone missing a phone? Maybe look. Sharing is caring, so is someone missing? I think it's okay. To Google, okay, yeah. Okay, we have already a winner today. Then let's see, the clicker is working, so yeah. What is SAMBA? I hope most of you know it. It's an alumni association of the leading universities, and we do events like this one for you regarding investment, digitalization, sustainability, education, career, and new also pharma, legal, and diversity, equity, and inclusion. These are our university partners. It's getting more and more, luckily, and also company partners. With them, we have special deals or do events together. Then what we have in the pipeline for events, if it goes now, we, of course, today, the investment leaders, and then the highlight of the year for us is the sustainable leaders in December. Would be great if you can come also on the 5th of December in the Google office in Zurich. As all our events, it's online, so you can join also virtually. Then we have already the Digital Leaders Conference in May 2024. That they are fighting BCG, PwC, both would like to do it with us. We will then decide, and then the marketing leaders, future of mobility, and the monthly investment roundtable. I think most of you have joined. So we have here Markus Käser also, and Gabi as leading the monthly investment roundtable. And we have also Steen here, so it's great, from Saxo Bank. We could, if you can click maybe on the next slide, we see that we could win Steen Jacobsen from Saxo Bank, and Antonio Savocca, former Saxo Bank also, and they do like a mini, let's say, interview, and Tony is more the trader, and Steen the brain, the macro view, and yeah, it's very interesting. And then at the second part, half, Markus Käser is inviting always an interesting asset manager, and they present their strategy. And now I would like, on the next slide, you can see Markus Käser and Gabi. She's also here. Gabriela, thank you for coming and for the great work you have done. And of course, all the others, Hakan, Natalia, Roger. On the next slide, and Moimir, of course, and please scan to vote. I would like to get your feedback. You need to open your phone and then scan it. We have a quick survey. Is it working for you? It's a Mentimeter. Yeah, it's working. So one question is to get some insights from you, and the second is more for us to improve, that we can do events for you. Thanks. And then last but not least, if you have done it, there is another QR code if you want. It's not necessary. We have also a WhatsApp group where we advertise or share news. And you're welcome to join, but of course it's not necessary as you want. No, wait 1 sec. And then, yeah, we would like to start, and I would like to hand over to Graydon. That's a big, yeah, weakness of myself, the names, Graydon. So I'm very happy to have Graydon here. So he's representing Ginetta and as a client partner. And yeah, Samba had already from the beginning partnership with Ginetta already with Benno. We were working with them together. So they are specialized in digital strategy and design. So I knew them as fantastic website designers. And as you have seen, they have also amazing offices. They even have also downstairs a kitchen. So they're really treating their employees very well. So I'm very happy that we can be here and would like to hand over to you. Thank you so much.
Okay, thank you. Hello, everyone, and welcome to Ginetta. It's a pleasure to have you all in our space. It's a space we're very proud of. It was a ton of effort putting this together, and it's actually very representative of who we are as a company. So my name is Graydon, and I'm coming to you from Toronto, Canada. I always, while traveling internationally, try to put emphasis on the last T, Toronto, because often Canadians, we just roll it and say Toronto really quickly, and people think I'm from a place in Italy or Latin America. So for the past 10 years, what I've been doing is working with a lot of complex enterprises across industrial sectors, financial services, to really come up with digital technology solutions for business challenges. And it's probably my favorite thing. Sorry. Okay. There we go. I just have to wait for the delay. So typically, what you see behind me right now, and actually if you look behind at the very back of the room, you'll see the words "we simplify." And it's something we talk about quite frequently, because so often when we look at digital challenges, and I'm sure many of you have seen this across your organization, you start off with a complex challenge and often move to an even more complex digital solution. So one of the things we pride ourselves on is really coming up with simpler, easier, and more human-centered solutions. Often one of the best ways to describe what your company does is just by sharing some of the work you've done. If I put this, oops, do I go back? Okay, we're good, sorry. So with BIS, the Bank for International Settlements, we worked with them to help central banks understanding a lot of complex, quick moving information in a very dynamic atmosphere to help them make decisions quicker. With CTA, CTA is a heat pump manufacturer in Switzerland, and we help them completely change their business by becoming more digital. And we help them create a complete, both conceptualize and execute a complete digital roadmap to allow them to better serve their customers in a digital space. No, sorry. Last word here. Okay. Last word. With Hexagon, this was fascinating. So Hexagon was an organization that traditionally a lot of their sales and marketing efforts were done P2P, were done face-to-face by their salespeople directly interacting with customers. And they needed a way of engaging with their customers digitally. So we actually created 3D models that you can interact with. We created an airplane, a car, and a wind turbine that you could actually interact with as finding a different way of exploring Hexagon solutions and engage people in a scalable way. Anyways, we are not scanning through. Anyways, I'll talk without the backdrop for a second though. And typically, so how I often would describe Geneta is at the core of who we are is human-centered. So the reason people come to work here is because we're passionate about humans more than we are about technology. Because, and we remember why we create, technology is always for humans, which is why at the start of everything we do is user research. And user research is a huge we started in the way we were founded, the way we continue to work. And our user researchers that come from psychology backgrounds actually make us better designers, better technologists, and better strategists, because they're constantly challenging us to validate this with people. Are we making people's lives easier and people's lives better? We also, and typically why people come to us is they come to us with very complex challenges because they're in a complex environment. And our job is to take these complex ideas and to progress them forward, is to help conceptualize this information, help visualize it, and turn it into a real digital product. Anyway, so as mentioned, my name is Graydon. You'll see a few of us throughout the room today. Nadine is here as well, and I think Nicholas is joining us. Enjoy the session today, and hopefully we get a chance to talk to you over a drink today. Welcome and thank you.
Yeah. Then we would like to show the results of the survey we did. And in the meantime, we can already let the panel one speakers join. We have here Thomas Wille, he's the former CIO of LGT, so, and also the moderator. Yeah, I give you. So there we go. Put it here. Oh, yeah. You see what the results were. So, I mean, most people, they are interested in venture capital, okay, and then in growth investing, yeah, and not so much in value investing, in risk mitigation, ESG at least, but yeah. So then, yeah, looking forward. What will be the today outcome of our experts, Dean Jacobson, and I hand over to Thomas.
Already working? I don't know.
Yeah.
Yeah. A little bit more. Does it work? I don't think so.
Yeah.
Yeah, okay, good. So good evening, ladies and gentlemen. This is also the first time for me here, because normally I'm sitting on their side, but Marc-André told me and asked me if I should come to the moderator side. Normally in November, I always do one thing. I go back and look what have those guys actually said a year ago, because that's a really interesting part. And when I looked through the Goldmans, to the Morgan Stanleys or Merrill Lynch research, one thing was on the top of everybody. How sticky is inflation in 2023? And what is then also key, if I would have told you that the US interest rate, the whole US interest go to 5%, and that we still have a kind of a hawkish Fed. And then in Q1, for example, we had a little issue in the US, probably Silicon Valley Bank, the implosion there also with First Republic. In the second quarter, yes, good. Good. And if I would also have told you that in the third quarter, for example, we had the Groundhog Day in Washington, debt ceiling, I guess not a lot of people, including myself, would have thought that the Nasdaq would rally and the S&P would be like up 15% year to date. It's not me, it's me.
Yeah,
Good.
maybe you.
I just try to continue. Is it working? Sorry, it's not me. Okay. And what you should also not forget, tonight we have here 4 experts, actually 5 experts we have here tonight. We will have a discussion about how we see the macro part and also what are the key risks for 2024. But you should always keep something in mind. The US Fed remains data dependent, which means they are just looking what the data is actually coming in. So it will be a balancing act in the next couple of like 45 to 50 minutes to ask our experts about 2024. And with that, I would say, when I saw like 2 minutes ago how Sylvia prepared herself, and I have this little iPad here, I just thought I'll do as good as a job as you will do. Okay, I just want to introduce the panel for a second. On the right side here is Steen Jacobsen, he's CIO from Saxo Bank. On my right is George Leontaris, he's the CIO from HSBC Private Bank. We have Charles Monchon here from Bank C, also CIO, and from Schroders we have, last but not least, Giovanni Leonardi. Good. One point I forgot to tell you is that in Q4, we also had then another geopolitical event. Normally, if you go into the past, you would say, okay, oil prices have to spike, but the opposite actually happened. But let's come back a little bit to the inflation story. Where are we on the inflation side? What's your view for the coming like 12 to 18 months on the inflation side? Is it still an issue, or do we have other issues?
First of all, of course, I have no clue, but I give it a stab anyway. It's pretty clear to me if you look at the geopolitical environment, if you look at the structures of what we now call fragmentation, that everything that goes on in the world is inflationary. We have, of course, seen that the super BRICS, as you know, have the 6 biggest oil exporters and the 2 biggest oil importers. They don't give a toss about the West. It's going to increase the marginal cost of energy going forward. We are deficient in energy. We're deficient in computer power. We're deficient in electricity grid. We are deficient in defense. We are deficient in reshoring, onshoring, and all these capabilities. So the new inflation floor in US terms is probably at the low 3%. The ceiling is probably 6%, but the volatility between the two will be massively increasing. And I think the net conclusion from here onwards is that we are very, very close to, by the bond market being forced into really have a real business cycle again and price discovery. So, you know, prices cannot come down from this level. Of course, as we've seen today, you can have a marginally improve, and then you can make all the sorts of statistical quirks. The super core is down to 1.2% year over year. Who gives a toss? The inflation is still the same at the counter when I go shopping, and the overall price level is not coming down. It's stabilized, but it's not coming down, and that will be the balance of the next year.
George, I guess you're also in the process of doing the outlook. What's your stance on inflation?
Yeah, absolutely. I mean, what we have witnessed is a clear deceleration on headline inflation, but obviously core inflation, a lot of underlying pressures still remain quite sticky. I do sympathize with the view that the outlook remains uncertain. Policymakers are very hesitant to confirm their policy stance. They are still data dependent. I would say that a lot of the uncertainty for the outlook going forward is linked to the trajectory of wages. For example, in Europe, we see that wage growth is still quite sticky. That does create some upside risks that can't feed through to prices. Geopolitics, not unresolved so far. It hasn't hurt or spilt over. But again, the outlook on the energy side can be unpredictable, and there are some risks. We're of the view that core inflation should continue to trend down. We got a positive inflation report today. Of course, we're not reading through just one single print, but we think the combination of base effects, lower rent prices in contribution, and a gradual cooling in the labor market should start easing some of the pressures on the services side. So we think about a year from now, core CPI should be one turn lower than where we stand. And ultimately, we do think that this gradual deceleration in core CPI should pave the way for some gradual easing by the Fed next year. But at the same time, there's a lot of structural issues that should keep the longer term pressure on inflation quite elevated. So certainly inflation is going to be a topic that will stay with us for some time, and we're going to have to deal with it.
How do you see that, Charles?
Yeah, first, as mentioned, it's a never-ending lesson of humility, and I think that there were two big surprises this year. The first one was AI and all of the, let's say, positive consequences on earnings and on stock performance. And the second one, if we look at the numbers which have been published today in terms of CPI in the US moving very close to 2%, is inflation coming down at a time where growth has been doing well, unemployment rate has been very low. I think that's the key question for as we enter 2024 is, first, could we get the same kind of boost on earnings as the one we saw coming from artificial intelligence? And two, in terms of growth versus inflation, are we going to get the same type of, let's say, ideal coupling between the two? So inflation coming down while growth staying quite good. It might actually be the other way around. So inflation not making more progress and growth starting to decelerate because we get less stimulus coming from the fiscal side. In that context, if we get, let's say, lower growth than expected and higher inflation than expected, then the outcome for markets might be a bit more difficult than the one we got this year.
What's your take, Giovanni? Before then hand over to New York.
I think inflation is here to stay. I mean, we have to get used that inflation is going to be around 3% because all the change which is happening in the world and we are wishing for, you know, decarbonization will have an impact on prices. If you want to do all that change, you need to pay for it, and we're going to pay the price. So therefore, inflation is going to be maybe marginally higher than the targeted 2%, maybe 3%, maybe 3.5%. I can't tell you, but I think we need to get used to that. And actually, you know, to have a positive inflation and not deflation, maybe also not a bad thing. We are just not used to that because for the last 15 years, maybe some of you went through other periods, but you know, we went through periods of zero interest rates and zero inflation, and nobody knows how to cope with the rest. You know, bond managers who haven't ever run a bond portfolio with high interest rates. So I think that's the change, but in a positive thing, I think we are in a good equilibrium now. We are getting time value of money. It's the first time you get paid to put cash on an account, maybe not in Switzerland, but around the world. And I think that's what we start to realize, and we all need to accommodate that. But for inflation, I don't think it's going to disappear.
Good. Then I want to welcome Gina. Gina Martin Adams, she's Chief Equity Strategist and Global Director of Equity Strategy from Bloomberg. So whenever you want to know something from Bloomberg, she knows everything, even I think before you even publish it. You heard us a little bit, Gina. What is your take on the inflation growth mix for next year?
Yeah, so I think I sympathize with most of what the panelists have already discussed, where we still see a cyclical deceleration in inflation, but probably not to a level that makes anyone feel comfortable that inflation is gone or moving back to the sort of low or suppressed inflation environment that we were in for much of the last 2 decades. I think that the really big challenge for equity markets that hasn't been surfaced that I would just add to the panel is not only are we likely entering an environment of potentially more secular inflation than we're accustomed to, but also dispersion in inflationary conditions around the world in an environment in which we are more deglobalized and desynchronized. as a global economy than we have been in quite some time is creating really significant challenges for portfolio managers who are more globally centric. And then I would add on top of that the idea that inflation volatility appears to be more elevated in this environment where inflation is not only higher for longer than we had become accustomed to, but also much more volatile and more supply driven, which creates a lot of challenges for investors that are frankly quite conditioned and accustomed to a 20-year period of decelerating inflation, disinflation, if not deflationary pressures that really predominated the investment landscape. And this is creating a lot of challenges, not just in asset allocation, but also even just in the individual equity markets from a global portfolio strategy. I think that we want to watch that inflation volatility as well as dispersion of inflation around the world as really key challenges for managing our portfolios.
You know, this year especially, there were so many scenarios like no landing, hard landing, soft landing, recession. I mean, now I'm sitting on the moderator side, so I can ask you that, is that what's your scenario number one? Will Jay Powell make a soft landing? I think a soft landing actually never has occurred, but still. What's your take?
So we have a little bit of an alternative view as to where the economy is, mostly because I'm so profit-centric as an equity strategist. My models suggest the US economy actually fell into some version of a recession in 2022. We run an economic regime model that gives us an assessment of the real-time economy, and it suggests that the economy fell into recession in 2022. We dug our way off of a bottom. I wouldn't say we necessarily entered some reemergence of recovery in 2023, but we did see a momentum shift in the positive in the first 3 quarters of 2023. But we just ran it again, and as of October, the model would suggest we're only a 5% probability of being in recovery now. So our models would suggest we fell into some sort of a recession in late 2022. This is a job full recession, so it's very bizarre, but it fits really nicely with what's happened in the profits landscape, which is trailing 12-month profits in the S&P 500 have fallen 13% from their peak back at the beginning of 2022 and are still, struggling to stabilize here. So our view is we've been in some form of a recessionary malaise or a growth slowdown. This is accompanied a pretty significant deceleration in inflation conditions throughout 2023, and that does appear to persist in the short term. Our economists do the forecast for the economy, and they do think that the US economy is falling into recession officially in the 4th quarter of this year, as the recession dating committee really considers employment as a key consideration of what is a recession in the US. We do see enough weakness in the job market for them to officially declare recession, they think, as of the 4th quarter of this year or present time. And that recession will be light, but persist through at least the 1st quarter of next year, if not all the way through the first half of 2024.
Okay. Dean, do you think a recession is around the corner? Or really a slowdown?
I don't think it matters. I mean, I think the question should be asked differently. We said 1 year ago, if Fed continues to hike interest rates, something will break. I think something has broken. To Gina's point, 2/3 of the US economy in terms of employment is in recession. How do we know that? We know it because we see, of course, the SME is struggling, but you can just go to the indices and look at Russell 3000, it's down 2% year to date. And then you have NASDAQ with the cyclical stocks sitting at 35% off for the year. And inside that, you have stocks that are 200%. So you can easily have, and that is the confusion we have when we try to do all this economics parlance, is that you can have inflation and in deflation at the same time. You can have recession and acceleration in the economy. But what is happening is that the 1/3 that is still accelerating or stabilizing will slow down significantly. We know that because the WARN notices, which is the leading indicator of jobless claims, that will start to kick in this Thursday. And then we probably, subsequently over the next 4 to 5 weeks, we will reach 260, 275 a week. And then unemployment by Q1 will be 4%. And that's the only thing that really matters to the market, in my opinion.
What do you think, George?
Yeah, I mean, look, I guess to the points that have already been made, earlier this year, we were talking about the possibility of rolling recessions, which is yet another terminology, or uneven recoveries, right? I think the way that we look at it is, first of all, we're looking at the traditional measures, where the statement can often be made of a recession in the backward-looking mirror, where it's often declared after having already experienced. On our point of view, the way that we look at it is on a relative basis, where the various countries stand on the economic cycle and how the composition of their debt is structured. And what we highlight is, for example, the US. One of the reasons why they've demonstrated the resilience that they have up until now is really due to the fact of the composition and the quality of their debt. So it's true that over the last few years, post-pandemic, there's been a lot of debt, thanks to the low and negative interest rate environment that has been. But at the same time, if you're looking at the composition of debt out there, if you take households, for example, 70% of their debt is mortgages, 90% of that is fixed, and most of that is long dated. A lot of households in the US managed to refinance their mortgages at a time when they were offered 3% rates or 4% rates on their mortgage. They seized that advantage. And right now, 3/4 of households are paying a mortgage rate in the US, which is in the range of 3 to 4%, and sometimes even less than that. So I'm not saying, and that links with inflation, prices are a concern. The lagged effects of monetary policy are still to come. But there's been this relative resilience due to the fact that the rise in rates hasn't really burnt the consumer up until now. Wages have increased. There's been some pockets of buffers, cash. These are running out, but this is really why we've seen that extension in the cycle that we've been witnessing so far. That composition of debt is also mirrored on corporate balance sheets, where basically you see that 80% of corporate debt is long dated and fixed. That's double the proportion in the post-financial crisis. So again, we're not saying that the world is going to boom ahead, but this is one of the reasons why that cycle has expanded so far, and why the traditional measures of GDP, for example, consumer, have been trending up. It's that debt composition, it's the status of the labor market. For us, we think that the US will retain that relative resilience versus other markets. And that's why in our asset allocation, we do have a preference for US over other regions.
What do you think about Europe or China, growth-wise?
So starting with Europe, I think that the big difference between US and Europe, behind all of the secular weaknesses of Europe, including the fact that they are struggling to source energy, going forward, is the fact that Europe didn't get all of the fiscal boost that the US got. I think one of the big surprise we had this year in the US is that at the same time the inflation was still high, at the same time with the Fed was staying hawkish, they got some help on the fiscal side, which is probably something which is not repeatable, because now they are hitting a wall with this huge, let's say, mountain of debts, which is costing them more than $1 trillion a year. Europe hasn't got this fiscal boost, and this is probably why they've been underperforming now. So we believe that going forward with, let's say, a less hawkish ECB, even maybe a ECB turning dovish, the fact that the consumer can recover, and then last but not least, manufacturing activity stabilize, there might be a case, at least a tactical case for Europe, where again, it's possible to find some very interesting stocks. Europe is one of the areas where they are taking advantage of what we call the recession. Look at Ferrari stock, for instance, trading at more than 50 times or new all-time high. So there are some stocks in Europe which are doing well. Very quick word on China. Obviously, this has been the big, let's say, disappointments of this year, with been in terms of economy or stock market performance. This week, there is this big summit where for the first time, I think it's since a very long time, Mr. Xi is coming to US soil to try to discuss what is possible to do between the US and China. We believe it's a lose-lose. You can see for the first time ever, FDIs in China are in negative territory. You can see US Treasury holdings by China is going lower. So this kind of, let's say, East-West divide is not working well. Will they come to any agreements? We believe it's too soon for this to happen. That being said, in terms of China equities, just one number, Alibaba is now the leader in terms of e-commerce in both Asia and Europe. And the stock is trading at 10 times. So like always, yes, there are many risks in the stock market, but also some opportunities. So we believe that in the long run, there are still some interesting opportunities in China.
John, we discussed a little bit before about the 2% inflation target of the Fed, and people said about reshoring and also the demographics. Can I ask why are the central banks for the time being so focused on those 2%? And do you think that in the next 1 to 2 years they maybe deviate from that?
I mean, I personally think that there is no real economic theory to underpin the 2%. This was just, I think, the first central bank with
New Zealand.
was New Zealand. I don't remember when, but from there, this target rate came up of 2%. It's a communication exercise, and you need to commit to the 2% to keep your credibility. So, in my opinion, we're going to see the 2%, but internally we looked at all the I call that the medium-term forces. So the demographics are going to be inflationary. The decarbonization is going to be inflation, and maybe it's the wrong word, but the deglobalization. So putting a little bit of production closer to their risk, the chain, is also going to increase prices. And therefore, I think we're going to accommodate with higher targets. The question is how to communicate without losing the pace of the market. But I think the market is already adapting to that. So from that point of view, I would expect that to come. I can't tell you when, but it's going to be a change. Maybe the others don't agree on that. But
you agree on that?
It makes perfect sense that it's 3%. If you look at if you split the inflation rate into goods and services, service inflation has been 3% exactly for the last 20 years. So that is the one you should target, because of course, for most economies, it's 60-70% of the total mix of growth and spend. So it's only the consumer goods, which comes from the China story. Now we have delinked the China impulse in terms of the trajectory lower. So goods will now trade at 3 to 4%, 5%, depending on how much deglobalization or fragmentation we get in the world. But it's pretty clear that if service inflation is 3%, they need a 3% target. But I have to question the fact that they're going to gain any credibility when you don't have it. I don't think you could lose something you don't have, but that's another story.
Okay, so if I sum it up a little bit, we expect that growth is not falling off the cliff for the next year.
I think Gina and I seems to be in a camp where I think there's a significant slowdown, but it will feel.
Falling off the cliff is like GDP contracts by 1 or 1.5%.
It could be in Q1, but you have to remember the impulse that came from Q3 being as high as it was. Means is it mathematically impossible to do anything in Q4 if you look at the GDP. If you look at GNI, we're already negative. So if you include foreign investments into the US, we're negative. But if you do it in a GDP term, which is probably the wrong way to measure it right now, by the way the economy is set up, then we will probably end up at 1.25, 1.5. But like for like is going to be very difficult in Q1 because the fiscal stimulus is out. You have the impact of the fragmentation in the world, and you have the full fruit of probably the compounding of the interest rate effect. Don't forget, the single biggest issue, elephant in the room, is that US has expansionary debt that is infinitely increasing at a real rate of 2.5%. If you want to commit suicide, that's the right way to do it.
Okay. And on the inflation side, I just have to sum it up. We actually expect that inflation will slowly go down to the 2% target.
Not for me. I think we all said 3% pretty much. I'm seek agreement here, but
we might see the 2% for a short period.
Gina, what is actually your key risk for next year? What could go wrong?
I think inflation is a bigger risk than growth because I think that that's what the markets are least prepared for. I think the markets have been very conditioned to prepare for growth slowdown. And when the Fed is increasing rates, we immediately think growth slowdown, it's going to happen. We're automatically going to get there. And the playbook is very consistent. Fed increases rates, creates a growth slowdown, inflation is not problematic, and therefore there's a playbook. I think the bigger risk is that inflation is stickier than many had anticipated. Even with a growth slowdown, we have stickier inflation, and that will, as a result, restrain the Fed and global central banks in general from being able to re-stimulate growth to the degree that they have in the past. I'd say second to that, the other key concern that I have about the markets right now is that there's a really clear misunderstanding of where we are in the cycle. As I mentioned at the onset, I very firmly believe we've already started a downtrend cycle. We're in the midst of a downtrend cycle that is merely continuing and getting worse over the course of the next quarter or two. It looks very different than past downtrends. And we have the lack of policy put to create the recovery cycle out of that downtrend that we normally do. And that creates a lot of complications for an investment strategy, particularly considering, again, how conditioned the investor universe is to constantly obsessing about growth as a primary factor for investment strategy, constantly focusing on growth, not focusing on inflation and how that may be impacting corporate margins, and then really missing the driver of all of the problems in the broader corporate profit streams really have been about inflation and company navigation of a new inflation landscape, a new inflation regime. So I think inflation is really still very misunderstood as to how it is impacting the broader corporate profits landscape, how it's impacting the economic figures. I think we're way too focused as an investor class in most recent recessions as guidance for what to expect in the current climate, and sort of missing the big picture as to how things are already shifting and changing in the investment climate.
So you think therefore that the Fed does not have the flexibility like in the past to lower rates because of sticky inflation? So it's more higher for longer. Giovanni, you think?
I do. I think they may get a couple of a couple of cuts. If we do see a pretty significant growth deceleration, they can ease a tiny bit, but not until the latter half of 2024. And that's a big if for me. I think following a historical playbook right now is going to prove really faulty guidance and a really faulty investment strategy. Instead, we have to be really sensitive to real-time data, real-time profits cues, real-time signals, because this experience just does not look like recent experiences, in particular in the US economy. It looks nothing like the financial crisis. It looks nothing like the downtrend in 2001. It looks nothing like 1991, for example. None of the indicators that we can traditionally use from a recessionary playbook are valid in this particular climate. We've never been through a period of time in which corporate profits fell 13% before we were officially in recession. It doesn't exist. And that's the environment that we're in today because of an inflationary shift and because of supply chain shifts that have happened and accumulated over the course of several years. And I do think we have to just be a lot more sensitive as to the real-time data and how that is impacting corporate profits and the economy at large. And it creates a lot more complication in an investment strategy than I think we're willing to kind of acknowledge or put to work.
Giovanni, you also think that the Fed has limited flexibility because of this?
Spoken before that, I think central banks are really in a difficult situation where they are walking on a nice edge. And the problem is, on the one hand, they want to control inflation, but everybody talks about equities and how risky they are. Nobody is talking about government bonds and how risky they are. You said it before. The way this financing has gone to all these climates, and then you look at the US. I'm originally Italian, so I can say that. I compare Italy and the US, and it doesn't really look much better. The question is why the market still continues to have faith in that. And the big risk is maybe somewhere in the future, somebody starts to ask himself, what do we do with bonds? Usually if you have a lot of debt, there are several solutions to a lot of debt. One is to try to repay the debt, and you're lucky if they repay, or you extend the debt, or whatever. So I think we have a big unknown. And the key variable for this unknown is what central banks do. And we don't know. We don't know the new reaction function of the central bank. It's the first time central bank increased interest rates so fast. I mean, we are used to 25 bips, 50, maybe 75. But what we have seen in the last year, this is extraordinary. And actually, I was surprised how resilient the economy is. I mean, I would have expected, you know, a few blow-ups in the companies, but that's true. Maybe the managers have been smarter and financed longer term. So we're going to see the second and third round of these higher rates in the next 18 months. So that's the big question for me at the moment. It's not companies, maybe there it's going to be sold. It's more the governments. You can take the UK, you can take the US. And actually, I would ask myself how China feels with all the books full of US.
What's your key risk, Charles? In
Well,
the same direction?
Yeah, I tend to agree. I think, you know, if you look at recent history, all of the financial crises came from over leverage. So 2000 was over leverage on the internet stocks. 2008 was over leverage on real estate by banks and consumer. This time, who is over leverage? Not the consumer, not the companies, governments. And we saw, as you mentioned, UK last summer, there was already a crisis. This year, we haven't seen anything too serious in the US, but that can come. And that could be, by the way, one of the surprise next year could be, you know, if the US follows the playbook of Japan, why not some yield curve control? If, you know, with 25% US Treasury, 25% increase in US Treasury supply next year, what if, you know, they lose control on the long end of the curve and they come with yield curve control? The Treasury or the Fed start to, you know, buy the long-dated bonds, basically doing interest rates for the people and QE for the markets, something like this, which could be, by the way, something positive also, believe it or not, for risk assets, because if you do this, yes, indeed, it might help long-dated, let's say long-duration stocks, like, for instance, tech stocks. So I tend to agree that this is a risk. I'm sorry, it's also a risk for Italy.
Yeah, I know.
Yeah. So yeah, all of these over-leveraged countries are facing that kind of risk.
Look, I'm from Greece, but
I didn't want to mention it, but
we're actually in a much better situation because we already went through the default. So the average debt maturity of our bonds is closer to 20 years. The average interest rate is about 2%. Our fiscal discipline is much better. So the problem is that we came from a pretty bad situation. But right now we got awarded to investment grade. So, you know, it's a different situation. But, you know, going back to your point on inflation rates, you know, there's a couple of factors that have been discussed right now. I mean, I agree with what Gina mentioned, the fact that, you know, we had the investment manager survey coming out, you know, what most fund managers are talking about, only 6% perceive inflation as a risk next year. So it's true that there's a little bit of complacency. We are of the opinion that core inflation will go down, but, you know, when you're talking about risks, that is a risk because many people are not positioned for inflation to come back. And when you're looking at the reasons as to why the Fed will cut, I think that a lot of the voices here, which some are calling for a more pronounced slowdown than what we are saying, but it is true that you know, the growth outlook should moderate from current levels. And in Europe, we're probably already in that recession. We're feeling more of that pressure, and yet we're seeing pushback from central banks. They're more worried about inflationary pressures rather than acting on any growth deceleration. So it would really take the economy falling off a cliff in order for those central banks to really start worrying and to bring forward their cutting cycle. Long story short, we think the Fed will cut a couple of times next year, but not before September. And again, that ties into our fact that we expect core inflation to go closer to 3%. It's not 2, but it's probably closer where the market equilibrium expects inflation to settle down, at least in the near term. And again, that goes not towards reversing interest rates to back to where they were in pre-COVID levels, but on the back of what has been the most aggressive hiking cycle, core inflation closer to 3 should give a little bit of confidence for central banks to gradually ease in smaller clips their interest rates, but still rates will probably stay a little bit higher for a little bit longer than what we've been used to in previous years.
Steve, we spoke about the huge debt level, but if I compare debt to GDP, yeah, it doesn't look that good. But what worries me a little bit as an investor is that I think right now the US spends almost $1 trillion or a little bit more just to service the debt Just from your point of view, how much longer can Washington actually kick the can down the road by just saying, who cares about the market?
Sure.
Or will the market tell Washington stop by just demanding higher rates?
I think that's exactly what's going on. It's kind of interesting. You have a big focus on inflation, but the latest move in interest rate has two key components as drivers. One is the fact that the major banks in the US held to maturity, which is where all the losses have been absorbed. But for some reason, we don't account for it. A Bank of America sits on $300 billion worth of losses in their held to maturity portfolio. Across the board, they have more losses than they have equity. I mean, that's number one. So when they have all these losses on the book, do you think the CEO and CIO of Bank of America are going to go buy the bonds? Of course he's not. So he drives up the term premium. On top of that, on the QT, we moved from the Federal Reserve buying $90 billion a year to sell a month to selling 90 to buying one to selling 190 billion a month. So we have a swift 180 billion. Those two drivers are the only thing that's moved in the last 3 months. The break-even forward rates, whether you look at 1 year, 5 years, 10 years, 30 years, is 2.25%. In other words, the only thing that's going up is the real rate. The thing that breaks the bank is the real rate. And I just go back to the fact, all of these conversations, with all due respect, we've just had is irrelevant. If we have 2.5% in September, we still have no real rate cuts from Fed into, then the system has blown up massively. And just for the record, every single move by the Federal Reserve over the last 10 years has not been because of a recession, but because something in the market did break. So we always have market events leading the actual economic evolution. This time we have the economic evolution and the fact that people are overly focused on inflation, which is one of the bigger mistakes in my opinion, because it will turn out to be whatever it is. But what will not turn out to be whatever it is if the Federal Reserve don't mitigate what is driving up interest rates. And that's why YCC is very relevant rhetorically, practically. And with that, a much weaker dollar, because if you fix the interest rate, you're also going to weaken the dollar. The only two levers you have to actually finance the deficit in the US. So the big way to make money next year is to figure out where the dollar goes. If you know where the dollar goes, you know where every single asset class will go.
Does anybody wants to make a comment on the dollar? Bonnie?
I think for short term, it's really difficult. The question is more longer term. How long will the world continue to use the dollar? But there is no alternative. I don't know if you want to invest in renminbi. It's not really the most truthful position. Then you take euro. You want to hold euro? I don't think so. I think that's maybe also what is giving support to the US. It's going to stay as one of the most important currencies.
Gino, when we have you here as the chief equity strategist, I have no clue about the markets. I'm completely naive. Should I buy the whole market or should I be a little bit more selective?
Oh, you should definitely be significantly more selective. As a matter of fact, I think that because of the dispersion of inflationary conditions and because of the desynchronization of growth globally, you are forced to be significantly more selective. When we run our global equity models, for example, right, you asked a question earlier about Europe and China. Our models would say neither Europe nor China. As a matter of fact, very consistently over the course of the last several quarters, it's pointed toward Latin America over all other emerging market regions. And within developed markets, it's pointed to Japan and to a lesser extent, Australia. So I do think you want to be very selective in strategies. I think in particular in an environment where you have much more volatile inflationary conditions, the only way to make money in stocks is through sector selection, stock selection, factor selection, or to be a tactical investor. Our return expectations for the global equity markets are low single-digit average returns into the 5 to 7 year time horizon. So these are very slow, low growth conditions in terms of equity returns. And therefore, you do have to be pretty selective, pick your spots carefully, and I think very tactical in your decision process, because it's just no longer a buy and hold kind of climate. It's no longer sort of buy the S&P 500 and watch it work for you for an extended period of time, in our view.
What do you think, Charles? of which sectors or regions you prefer?
I think if you look at 2023, what was the dream portfolio? The dream portfolio was cash plus Max 7, okay, plus Bitcoin, if you are allowed to. So what about 2024? I think a simple trade, or at least it's a key question to ask is, what do I do with my cash if interest rates start to go down? So what are, let's say, the segments of the bond and credit markets which offer a margin of safety and nice yields? I think on the investment grade yield curve, it's indeed, quite valuable to move some cash and to buy some high quality investment grade bonds with between, let's say, in the belly between 5 and 10 years in duration. And when it comes to stocks, maybe these Max 7 will have a pause, not just because they're expensive in terms of PE, but also because if you look at earnings estimate, they have been rising extremely brutally, plus 70% of positive earnings revision over the last 12 months. And maybe, we believe in this AI revolution, but it always takes more time than initially expected. So maybe it's good to take some of this money and look at all of the segments of the equity markets which have been kind of pricing some kind of recession, and some part of the equity market indeed are cheap. So move a bit of money of this AI and go into the laggards, the underdogs, which might play catch up next year.
Could you do the same strategy, like focus a little bit more on the S&P 493?
Yeah, fairly so. I mean, there's certainly been certain areas where we think that we have catch up. As I alluded to before, our forecasts on the macro side, but also taking into account some of the pessimism that has been in the market, means that we still are a little bit more constructive on the US than other markets. So we still have a cyclical tilt with regards to US. That's played in our favor to a certain degree. We've been riding on tech, consumer discretionary through most of the year, industrials. So these are positions that we've been holding on for some time. As we look forward to 2024, we've been trying to hedge our bets a little bit. So we have been adding a little bit more towards defensives. But clearly, I agree fully with Charles. You can't concentrate on certain stocks which are priced at much more aggressive multiples. We've been doing some exercises within sectors. Indeed, if you actually remove part of these stocks from the indices, you see that PE multiples are not as demanding as they optically look at, but clearly diversification, quality, looking at the amount of leverage. So again, filtering for high quality companies, that's really the positioning that we have on the equity side. And bonds, I also echo the thoughts of my colleague, clearly investment grade debt, but also government bonds where we've recently extended duration. That's really some of our preferred areas right now in our tactical asset allocation.
Do you have something different, more towards defensive or staples?
Very different. If you look at the S&P 500, how it's constructed right now, 90% of all assets are intangibles and 10% is tangibles. If we want to live up to green transformation, the fiscal push, reshoring, friendshoring, onshoring, whatever shoring in the world, we need to grow the 10% to a larger share of the total economy. The advantage of that is that if you can solve for that as an economic equation, you reduce the inequality, you reduce the inflationary burden, but it can only happen in the real economy. As much as I love the big seven, they are not offering me anything in terms of productivity. And then some of you say, oh, hang on, AI, whatever. Yeah, but AI is, we are priced the next 5 years of gains in AI anyway. Maybe in 5 years' time, they'll have an impact. But right now, for the next 5 years, I'm going to make money, in my opinion, by being long the tangible assets in the economy, which is part of the solution to all the fundamental problem we have. And on top of it, the inequality that society is showing left, right, and center, among other things, also in the Middle East, where all of a sudden it's not only us against them in terms of the West versus the rest of the world, but it's also religion versus religion. I think that is a very dangerous path that can only be solved in the real world.
Giovanni, let me ask you, not for a Swiss portfolio, because that's tricky anyway, for euro or dollar multi-asset portfolio, bonds over equities or equities over bonds? I always hated that question. I know.
Yeah, I know. It's not a nice question.
You can also say
That's
neutral.
why you took it at the end.
No.
I
Tina will also get that question. She can already
sympathize with this view. In our case, we started to lengthen duration now, and I think, given my view that we're going to settle for this 3%, and we're going to have a real interest rate, therefore you're going to get a yield on your fixed income portfolio. For me, it's kind of a unique opportunity for clients to have this, let's call it the safer portfolio part, yielding something. So therefore, you start to add investment grade and good quality government bonds to also stabilize the portfolio. On the equity side, I think you need a mix of passive and thematic to take advantage. And these are mega trends. These changes are not going to happen in the next 3 months. But if you imagine everything we have to do to get the economy in a way that we can transport the energy, what do we need? Materials. Unfortunately, if you look at the companies, we don't have enough materials. It's not there. So you need to find it. And the nature of the market is, if there is not enough and demand is very big, the only way to clear the market is to see prices go up. So that's why I think you need to go a little bit more selective on single names. But I don't agree on the AI. I think AI is the key for us to get the solution to this demographic problem. We need to become more efficient. And if we don't speed up this AI stuff, I don't know what's going to be the solution, I have to admit. So therefore that.
Gina, bonds over equities or equities over bonds?
Well, I'm an equity strategist, so it's always equities over bonds. But I do think that it's like I think this question is really dependent upon the investor that is asking the question, first of all. But in an environment in which inflation is going to remain relatively embedded and you're already getting paid for cash, I think you have to consider cash as a component of your asset allocation for the first time in a very long time. But I also think you have to consider real assets as a component of your asset allocation. And that's something we haven't talked a whole lot about, is when you're thinking about a broader asset allocation, it really is more than about just stocks versus bonds now. It has been for a long time, but more importantly now than in the last few years, certainly. And so I do think you want a more diversified approach. I am frankly quite fearful as to what's going on in the private markets. This has been the area where everyone has put an extraordinary amount of their assets over the course of the last 15 years has gone into private assets. And this is an area that I think we need to explore quite a bit more, but that's been the primary area of alternatives. And I do think that there are plenty of real assets that could fill that alternatives bucket as well, that have been neglected, where you could probably get some inflation hedge and diversification as well. So for me, it's not just stocks versus bonds. There's a lot of options. But if I had to choose stocks versus bonds, I'd choose stocks all the way.
Good. So I look already at Marc-André. I guess our time is running up. I would have 2 more questions, but we can talk that on the apéro. Would have been about gold, and then of course about the asset class that you mentioned before, the one that doubled this year, Bitcoin, crypto. But I think for the sake of time, thank you to all the participants. Thank you, Gina, in New York. Are there any questions? And I think you have the mic.
Yeah, so maybe questions from the audience. Thank you so much for the interesting panel. Maybe one question from the audience. Don't be shy. Okay.
So I saw that there was some debate about your positioning on AI as an investor, and I'm just curious, if you are, say, currently an entrepreneur, and running an AI startup, looking to fundraise, right? Is this a good time for you, from an investor perspective, to look into this?
I think from an investment perspective, you're going to have a good market to try to raise the money. The problem is that now interest rates are higher and everybody is de-risking. So it's a little bit a tough environment to do the new startup. So actually, most investors are rather going in more mature companies. So it's a bit a dilemma, but I think currently with the thematic, which is so strong, you can come over that.
It's true. What is very interesting compared to the dot-com era, for instance, where dot-com was, there were plenty of dot-com IPOs. Remember pet.com, anything.com, whatever. And this time it's just about 7 stocks which are taking everything. And the rest is not basically tradable. It's very difficult to find pure plays. So that could be the next step. Maybe not this year because of the challenges you mentioned, but later on, because we haven't seen, let's say, this second wave of, let's say, startups coming to capital markets to raise money.
Audience online, you can ask us questions in the tool eTrain. I don't know if you can make it this time, but for the second panel, please ask question there. Now, I think last question, Paolo.
Yes, hi everybody. Question: I was a couple of weeks ago in the US. There was a couple of conferences, Boston and in Chicago, and the topic was about the impact of high interest rates in terms of allocation to private assets. So there was some people that were basically seeing a long-term trend going in reverse, meaning rather than an allocation to private assets to increase, to actually decrease, because the absolute nominal return that you can get from bonds or fixed income products is or is starting to be competitive with what private equity or venture capital could yield. So what is the panel view on that? Thanks.
Who wants to take it?
Yeah, well, it is a fair point what you mentioned with regards to better competition for capital. I think that's also one of the reasons why fixed income has become quite a consensus trade, actually, and why it's regained the appeal. There's multiple reasons. I mean, of course, investors have been neglecting the asset class after the years of low rates, but also with inflation being problematic. Now with the market looking for a little bit of a peak, and given where yields are, clearly the appeal of fixed income has returned, and that's competing against a piece of the pie. So I think the one part of the argument is valid with regards to the appeal of fixed income. On the other hand, I think the investor surveys that we get from family offices, from institutional clients that are geared towards private assets, are still keen on adding the incremental piece of capital towards the asset class. Obviously, there's short-term considerations that obviously question the attractiveness of certain private equity strategies, for example, when you have to deal with an elevated cost of capital, when you're talking about illiquid nature. So of course, you have to be selective to a certain degree, but generally speaking, we believe that maintaining a diversified strategy that includes a combination of private assets will typically perform quite well. So, we don't believe that the trend will reverse completely. Maybe it will stall in the sense that in the short term, you're getting fixed income, you're getting a bit of prudence and risk aversion, but it's still a long-term trend that should continue to grow and attract money.
And I think what you should also not underestimate is the following, is that it's not only private equity, but when you're looking at private infrastructure, I mean, we discussed tonight several times that all the governments have far too much debt. So when that green transition, that green revolution should really happen, we need private companies doing that. So I completely agree. It's not so easy anymore. Like when you are at minus 75 basis points, the S&P, minus 30 basis points on the ECB to just collect money here in Europe. But I think private markets as a whole asset class or as a whole asset group has really established itself and will stay.
Yeah, so I think, okay, last question, yeah. And then 10 minutes
and then
break.
we have the very last question.
Yeah.
Very brief. Thank you so much. It was highly interesting to hear you with all the different arguments and go through the different asset classes. And what I found really amazing, I have to say that we have this consensus on inflation outlook. And being in the market for quite a long time, I tend to say that if everybody has the same view, then quite often it goes the other way. So that's why I would like to challenge this a bit. And I think also in light of, AI taking over more and more in different industries, which normally is has a positive effect on prices. So it's more rather deflationary. We have wars, which I think could also be quite disruptive for the economies. and also with regard to having potentially some recessionary tendencies. So the oil prices maybe cannot go through the roof. And also, I think we should also consider that there are alternative energies as well as alternative food, which also can have an impact on inflation. So I think it's rather deflationary, all these alternative options we have. So personally, I'm not so sure. I'm not so convinced that we're going to see inflation higher for longer.
I think if I can add one point and then I give it to you, is that I think Gina made a very important point, is the volatility of inflation. If the market can handle, when you have a constant inflation of 3%, the market can handle that. But one day you have -1 and then you have +6. I mean, we saw that in late 2021, beginning of 2022, when we went from 2 to 4%, the market were kind of okay. But then when it really shot up to like 5, 6, or even 7%, the point is that we have to look the long-term secular drivers like the digitalization and AI, that will definitely be deflationary. But all the others like reshoring, regionalization, we have some huge demographic issues that are coming, not today or tomorrow, but they will come to the end of this decade. Any other?
I would like to take part of it. I mean, I will make the bet it's more likely we get 6% than we get 2% inflation in the US. And one reason is the later part of what you mentioned. Food next year is going to explode in price for a number of reasons. Now, number one, we have El Nino, which of course makes the water warmer. We have 1.7 degrees increase in the average temperature in the world this year. And a lot of crop that is being grown is now in excess of 30 degrees Celsius. When you're at in excess of 30 degrees Celsius, actually you have rotting and you lose the biodynamic. You need the bacteria, you need the flies, whatever, they disappear. So right now in orange juice, in olive oil, in coconuts, in a number of really impacted by this increase at 1.7 degrees is already exploding. It's only a matter of time before it goes to the rest of the world. So what is going on is that in the southern hemisphere in the world, it's going to get warmer, much warmer. And as you can tell today in Zurich and where I come from, it's pissing down every single day in the northern part, and that's going to be the trend. We've seen more water than ever. The water levels in the northern part is normally what we have in March, which is the peak of the season. So in terms of all of these components, in terms of nature and everything else, it has a huge tilt and a huge convexity to the upside, which on its own, if we take core again, inflation, it doesn't matter. But for us, who needs to pay for food and everything else, is a massive. Energy cannot come down in price simply because of the trade routes and the inavailability. So I would say, if we are wrong, it's because we are all a little bit, trying to say it's 3%. If we are wrong, it's going to be 6, 7% again, and very, very quickly.
If I may, I think that the message is more that we expect it to be an average between 2 and 3%. The problem is that we're going to see these spikes, and I don't agree the market cannot cope. It's just going to take a bit of time, and then the market is going to get used to spikes and look through it. I think that's normal. The bigger risk is that if we are wrong, then it's going to be much higher. And this is I think that's really the big concern, because if inflation is higher, unfortunately, nominal rates will be much higher.
So I think that's a good start. So yeah, the real food then starts after it. So you still have to go through panel 2, but we have already some snacks and short 10 minutes breaks. And I would like to thank Thomas and Gina also for, Gina, thanks for coming. To all the panelists, Charles, Giovanni, Georges, and Steen, and of course Thomas for the fantastic moderation. Thank you so much.
Am I all right? Can you hear me? Yeah? Is this all right here? Yeah? Feels a little bit weird.
Eh? Ah, yeah. Does it work now? Do you hear me? Okay, good. Okay. Yeah, okay. Can 1, 2, 1, 2. Test. No. Hello. Test. Test. Yeah.
Hello, test. Hello, can you hear me? I don't know.
That's my.
Ah,
Hello, hello. I think it's coming. Hello, hello. Hello.
Prova. Hello.
We are about to start the second part of the summit, so please take your seat. So please take your seat. Can you put the mic on? Right, so thank you very much again for being here. And please take your seat and bring a drink or two, and the drinks will be served also during the second part of the session. Then we will have also a working event, but please do take a drink or two and take your seat. So welcome back to the second part of the Investment Leader Summit. And thank you very much for the wonderful bankers and also to Bloomberg to be here with us today for the first panel. We have heard wonderful insights about microeconomics. And now we're going to deep dive into the second part of the session. My name is Silvia Savini. I am an executive, global executive in banking and insurance with a focus on climate resilience, sustainability, and impact investing and value creation. I'm your host for the second part of the summit. So we have a wonderful group of speakers today for you, entrepreneurs and also investors, and they will be talking to you about their investment strategy. So what is the best investment to follow for the future and why this strategy will outperform? So very interesting topic. We will actually talk about private equity, private markets, deep dive into impact and sustainability investing, digital asset, all the way through equities, credit, and absolute return investing. The second part is composed by a keynote speaker and then a panel discussion. The keynote speaker is Mr. Pavel Ezekiev. Pavel is a serial entrepreneur and managing partner of Neo Ventures, an open-ended fund backing early stage entrepreneurs globally. He is also co-founder of NEVEC 1 and 2, institutional venture capital funds, backed by sovereigns, investors, and family offices. Pavel backed over 30 companies and exited 15 successfully and still counting. Prior to starting his own venture, Pavel managed Deutsche Bank in Bulgaria after working as an M&A investment banker at Deutsche Bank London office for most of his career. He graduated with honors from Northeastern University in Boston, majoring in finance. Pavel speaks Spanish, French, Bulgarian, and English, and he enjoys downhill, off-piste skiing, kite surfing, and filmmaking. Something interesting to know about entrepreneurs, right? They always like interesting. So please welcome on stage Pavel Ezekiev.
Thank you, Sylvia. I'm going to get shy because I saw my mentor from Deutsche Bank is here, and I cannot give BS when he's around. So thank you, everybody. Thank you for making it through the rain. See if I can switch. We manage it's actually a private investment company after having gone through two institutional funds. Institutions are great supporters, but they're also very heavy in administration and maintenance. And the year 2017 was very, very frugal for making something different. So we created early stage VC, which is structured like a hedge fund. In other words, you can make a commitment. Your commitment is taken up front. There is a share price at which you invest, calculated by a report of Ernst & Young, done on a quarterly basis, so pretty rigid. Fortunately, all of this is done in Bulgaria, so it's cheap. Our running costs are probably in the vicinity of 15-20K a year in terms of outside management fees. And we can basically have an open mandate to invest anywhere on the planet, so very opportunistic, very quick. And the LPs today are probably around 20 individuals and 4 family offices, 2 Swiss from Zurich and 2 US. About 70% of the money comes from these 4. I have to say we've been lucky, and we've managed to get to a place where we have identified a very specific niche called hyperspectral technologies for space and medicine, which means you beam something from a high intensity beamer. It's either a beam of light or a beam of infrared or something like that. It goes through a magnifier and then it hits a sensor, and along the way it detects things that are in plants, in human bodies, in human liquids, but also in space. So they can. We have we have a company which operates a nanosatellite constellation in low Earth orbit, which is being spoken about as the next big thing that Europe has to offer to the stage of the low Earth orbit. So Today we're managing 3 funds. Life one is being raised and paid back, and we're about to start raising number 5 because we see a lot of mispriced opportunities. And someone earlier talked about real industry, and I loved it. I don't know if the person is still here, but that's why we're definitely going. We have to fund. It's going to be a small fund, 50 million, and we're likely to get a mandate from one of the IFIs who fund everybody in Europe. You know who they are, and they're the biggest investor in this space. So it's just a lean structure allowing us to act in a very entrepreneurial way and remain true to our roots, which are all our entrepreneurs. The team is based a bit all over. I'm Bulgarian who lives in Spain. I have 2 US partners, a Chinese, Canadian, and somebody from Uruguay, and even somebody from Russia who is at the moment stuck in Russia and cannot get out. The institutions who have backed us range from EIF, EBRD in the past. There's a bank called Allianz Bank in Bulgaria, which I think only exists in Bulgaria outside Germany. And there is a bank called Bulgarian American Credit Bank. What we're about to do is different. We're about to do a multi-stage crossover, which means you can start from a scratch and go up as far as, let's say, early growth ticket. And then again, advanced materials, health tech, and something we call autonomous living. And that means everything that enables you to not depend on the monopolies that try to control our life so much. Oh, that's a symbol of Bulgaria. So geographically speaking, how does it work? I spent a lot of time in Latin America. I'm half Latin American by blood. And kind of Bulgaria gives me a flavor of emerging markets the way you people in Switzerland see it. So it's kind of a frontier, but not quite frontier. We have the benefit of understanding both how the Russians think, even how the Chinese think, because they invest very, very heavily. To give you one example, there's only 2 countries in the Eastern European EU members which are not allowed in Schengen. And those are Bulgaria and Romania. Yeah. And the reason why is they blame the legal system, blah, blah, blah. It's nonsense. Basically, the Dutch, are there any Dutch people here? They don't let us into Schengen, no Dutch people. The Dutch have a crown jewel called Rotterdam Port. That's where probably 50% of the traffic into EU arrives. Now, the Chinese bought something called Piraeus, which is the port in Athens. And they dig it deep, deep, deep. And basically, they've invested a few tens of billions there now. And they're about to start stretching corridors. And when that's done, bye-bye Rotterdam. That's why they don't want to basically allow the trucks to go through Bulgaria and Romania. A couple of curious facts. If you look at the world as a pie, as an apple pie, really, with the domination of 3 or 4 countries, the countries where we actually have sourced our best deals are the smallest ones on the map. So that's why we say we are kind of a edge investor. We cherry pick things. We are very, very focused on what comes out of Israel, because Israel, when you cross the Atlantic, there's nothing like it. I can tell you, they're so clever, so committed, so not full of themselves. Respect to the Swiss, but what happens in Israel is really unique. And Uruguay is a very strange place. Nobody knows anything about Uruguay, but it's a place where the 7 unicorns in the last 3 years, and they are number 2 in the Western Hemisphere in terms of business climate. So law works, it's safe, it's fantastic. It's a place I'm half Uruguayan by documents. So invite you to learn more about it, and we can tell you more about it. Going forward, risks. I think Warren Buffett once said, when everybody is afraid, I'm excited, and when everybody is excited, I'm afraid. So I copy paste this from somewhere, but if you combine 2 of the same colors and add a 3rd color, you have a perfect storm. And that's where all the talk about fixed income equities, it's going to change. Fixed income maybe won't change so much, but the equity market will change. The alternative assets will come back into play and commodities will be very, very big. So put any of those, 3 of those together with 2 of the same color and 1 different color, and you have a perfect storm and things will change. And I can tell you that because I was in the building when the planes hit the towers in New York in 9/11, 2001, and it changed. The next 2 years, there was just nothing. There was drought. Nothing happened. Probably that's the last thing I'll say, and then I'll invite somebody to say something very quick. How we pick our picks, we actually are quite top down. So we scan, things come through LinkedIn, things come through my Swiss network and my US network, but there is a very, very standard map, which is done by CBI Insights. And basically you can look at it, you can split it right in the middle, actually not right in the middle. The first unicorns came from this side, deep tech. And then it started spreading to the right. And if you look why it happened here is because basically this was a science tech-driven rush to new technologies. And now what is happening is this is consumerizing itself. So it's verticalizing itself. It's becoming available to more and more people who are not super deep tech. And I think where the opportunity lies, well, here it's already very big in fintech, but consumer retail and industrial and of course healthcare. So that's where we're going to focus most of our money and time and effort. Can I give it to Velina for 2 seconds and explain something, or should I get back? So I have a new partner, Velina. She got money from a few people, including us today, and she's doing something with cats.
Right. So, hi. Actually, not really cats, more like I have a startup. It's in pet tech. Anyone heard of pet tech? Okay, 3 people. Perfect. Now, if I say human tech, who has heard of human tech? No one. Okay. Why is that? It's because when we say tech, we generally consider tech as something about people. And this makes our pets that are basically part of our families not being able to experience the benefits of this amazing technology that we have today. And now imagine having technology that allows you, no matter where you are, to know how your pet is feeling, how it's doing, not just where it is, but getting those early signs of something not really being quite right. So focusing on preventing rather than treating some more serious condition. Now, imagine having this technology, for example, a collar on the neck of your cat. And now this collar actually talks to a smart feeder. And this feeder knows exactly how much to feed the cat in order to reach a certain goal, for example, lose weight or gain weight or maybe keep the weight. Now, I'm generally talking about embedding technology into pet care. And why am I doing that? Who am I, actually? So my background, I'm a finance person. I've worked in corporate finance in both UK and Bulgaria. But most importantly, I'm an only child. And me being an only child, when I was little, my parents were working, so I spent quite a lot of time on my own and with my pets. So basically, my pets have become like family to me. And I'm not the only one. To back this statement, the pet tech market is rapidly growing in value. So currently, it's $320 billion, and it's expected to be $500 billion by 2030. Now, from this, only 10% is pet tech. And us living in this digital world today, this is only going to grow, the share. And I can only hope that my company is a leader in that. So, yeah, thanks a lot for your time. Back to Pavel.
I just want to point to another friend, Meinhard, just raise your hand. Mindheart is a chairman of the best health tech company that's yet to come. It's testing your urine at home and enabling you not to go to a doctor and knowing a lot of things about it. It's about to scale very big, so have a exchange of contact with him. Are there any Americans here? Can you write a few? Okay. So I'm a product of the US education and early stage investing system because I worked at Microsoft in 2000 when people were sleeping on their couch and they were allowed to start a startup within the company. And there was a saying, when the Americans are all over the place, we're about to have a problem. So I opened this morning a website and I noticed that 6 out of 8 aircraft carriers are not where they're supposed to be. So what's going on? Not allowed to. Okay, discretion. I'm worried about it. I think everybody's worried about it. That's actually the number one thing I'm worried about, having done so much work in Israel and the Middle East. But I think it's going to be okay because there's elections coming, so we'll be fine. Anyways, any questions?
I think in the interest of time, we probably have to move into the panel, but please do approach Pavel during the drink. He has a lot of things, interesting investment to talk about, and we'll be delighted to take your question over the drink. Thank you so much, Pavel. Thank you. Very well. So I now invite the panelists to actually take a seat with me here. And we continue our, please do come. And we continue our conversation about alternative investment. So take your seat as you are, please. Thank you so much. So here, stage with me, we have Pierre Forget-Amezian, Chief of Staff to the Group Chief Investment Officer, and is Head of Private Markets at Julius Baer. Here we have Evelyn Fluggi, CEO and co-founder of the Singularity Group. Then we have Reto here in Heiken, CEO and Chief Investment Officer of Alpinum Investment Management. We have at the far end, Alex Raukenstein, CEO and Managing Partner of Strategic Investment Advisor, SIA Funds. And finally, we have Sebastian Heine, who is the Chief Risk and Compliance Officer at NorthStake. So I would like, first of all, to build a bridge of what we've been discussing before about macroeconomics. And I would like to start with you, Pierre, because you are the Chief of Staff to the Group CEO of Julius Baer. And I want to know what lies ahead of the economy and the financial market. What is your view, also adding and building on what we heard so far?
Thank you, Sylvia. I think we are rather in line with consensus when it comes to inflation expectations. Actually, we published earlier this year a paper titled 3% is the new 2% as a way to highlight that structural forces have shifted towards higher inflation for longer. But now when it comes to interest rates, I think the fundamental question for us is whether there is any structural change in the economy and in the global economy that will sustain a high level, a level of 5% for a long period of time. And I think this was extensively debated and discussed by the participants earlier. I think to take a bit of a step back, we were extremely surprised at Julius Baer about the pace and speed of the interest rate increase over the year. I think we did not really expect that the US economy would be able to sustain such a massive hike, and that we would expect that something would break at some point. Actually, we took a bit of let's say an original approach in a sense that we looked at the work of Richard Koo, who is the chief economist of Nomura. Richard Koo is a bit of a reference for us because he built the bridge between the monetarists and the Keynesians in how to look and how to read macro events. His book, you might know, The Other Half of Macroeconomics, is a very helpful reference that I can recommend if you like. And we look at balance sheets of the private sector actually as one of the grids to analyze the current environment. And if you look at balance sheets of the private sector post Great Financial Crisis, they have massively recovered, making a surplus across developed economies, not only in the US, in Europe as well. What I define as private sector is the private households, also corporates, the financial sector as well. And this has led to, essentially the accumulation of surpluses and a much better shape of the private sector over the last decade, which makes the economy and the macroeconomy much less sensitive to higher interest rates in terms of cycle. So that is one of the explanations why nothing has broken, according to us, and we are actually still anticipating a reversion because there are a lot of forces out there that pushes toward lower interest rates at a later point next year. Among which, one which was probably not mentioned earlier, which is the U.S. election that is around the corner, and that is probably a very strong force in driving the interest rates in the light of a very politicized Fed, as we have seen. So what has actually, as one of the consequences of this long period of very low interest rates, is the massive allocation of capital towards what we call the shadow banking system, in a way, which is basically everything which is not traditional and traditionally regulated. And that includes, of course, used to include crypto markets, but also private markets to a large extent, all the asset classes of private markets. And there's a lot of excesses actually have been taking place in these areas. So we are extremely cautious about the dynamics at play here, particularly in the areas which were very leveraged, or in the areas where expectations of growth and expectation of valuations were discounted at very low interest rates. So I think that's pretty much our view at this stage.
So with all this market distress, and with the prediction also that our bankers, your colleagues bankers, panel number one have done before. So what is actually where do you think we can find new yields? Where are the best ideas for investment in the future, in the near future?
All right. So in traditional asset classes, I think a lot was discussed already in the first panel. When it comes to private markets, there are actually a few pockets which are still very interesting, and which are actually even more interesting in an environment like this one. The first one that we actually like to look into is private credit, with a special focus in distressed and non-performing loans. Why is that? Because it's actually an interesting way to lock higher levels of interest rates while having a hedge on the recession narrative, right? You can actually work with managers who actually specialize in negotiating, covenants, playing mezzanine, playing the right, contractual framework with the companies that they lend money to, so that if things happen, and if basically the earnings of these companies are not as good as expected, there is even an upside for the lender in the particular area of distress. So this is an interesting area. The other area which we look into very closely is our secondaries investments. I think secondaries is a rather now mature asset class in private equity in particular. We look at both LP-led secondaries and GP-led secondaries as two interesting opportunities with two very different focuses, and for two very different reasons. LP-led secondaries, because you have what we call the denominator effect, where a lot of institutional investors heavily allocated into private markets are actually looking at reducing their exposure, because their share allocated to private markets actually is becoming larger and larger relative to the value of their other asset classes whose value has been reduced. So as a way to liquidate part of the investments or reduce their exposure, they become forced sellers to some extent of very interesting portfolios. And this is where a lot of interesting players in the ground are kicking in, and can provide actually access to this portfolio at attractive discounts. And on the GP-led side, we also have a situation where in the absence of an IPO, a strong IPO activity, and in an absence of a lot of M&A out there, many of the GPs in the traditional buyout space are struggling to exit. They don't find a way for their portfolios to, be exited as initially planned. And these robust and mature portfolios are actually sold to continuation vehicles at attractive discounts as well. Now, in this particular area, we need to be also extremely careful in the selection, because you can have a massive amounts of conflicts of interest in terms of setting the price between the buyer and the seller, because both work in the GP ecosystem. Some of them are even affiliated to some extent, or can agree on a pricing, which is a big issue. So what is key here is to look at first the alignment of interest of the continuation vehicle, making sure that the GP has really skin in the game while acquiring these companies, and that can be checked with the carried interest, the stake that the GP has in this fund, among others. And the other key component of that is to look at the valuation, obviously, that is set and appraised at the time of transition to the continuation vehicle. So that's about secondaries. Then maybe last and not least, one important area for us is actually to go back to basics, to the basics of private equity. That means going back to low to mid market buyout funds. Why is that? You have the performance of private markets. We can break it down actually in four major components. You have the multiple expansion, right, which can be a driver of performance. So the EV to EBITDA, which is the typical metric used. You have leverage, which is another one, which is heavily used in LBO particularly. You have earnings expansion, right? So how much the company is earning and how much is this earning actually going to grow. And you have margin expansion, right? How efficient is the company becoming throughout the life cycle of the investment? Actually, the beauty of LLM, or low to mid market buyout, is that we focus on the latter two, on margin expansion and on earnings expansion, which are the two components of performance which are less cyclical, which are less sensitive to interest rates, and which are actually the most promising. This is the true value of private markets. This is where the GP is going to be, smaller, specialized in a specific area, that will be negotiating a specific deal with, for example, a family business. You will not have a huge auction that will, fight for deploying massive amounts of capital into too little opportunities, and the valuations will not be excessive. That is, I think, the core of our strategy, and where we focus in this current environment.
And actually, I'm grateful you said that, because I wanted to also link to what your colleagues before in panel one were discussing about, which is basically like impact investing, climate resilience, ESG sustainability. There is a lot now of attention from LPs and from pension funds on that, in good ways and bad ways. I wouldn't say bad ways, but in interesting ways. And I wanted to know what is your view in this type of investments.
So in this area, we actually differentiate, we go a bit by the book, and we differentiate the core value of sustainable and responsible investing from impact investing. I think the key difference, because sometimes the terminologies are a bit, commingled and mixed. The big difference is that in the first case, you look at what positive externalities are these companies going to bring to the world. What positive role are they going to have in mitigating the challenges or overcoming the challenges of mankind right now?
So value creation.
Exactly. And in the other, in impact investing, you look at the positive externalities of you as an investor, right? And this is very, very different. That's why in the area of impact investing, we tend at Julius Baer to focus on private markets, particularly on private equity, because the money that is deployed by the investor, that is committed to the investor, directly goes to fund a project that will have a positive impact, as opposed to traditional equities, which is less of a direct, let's say, consequence and less direct influence. Now, looking at impact investing and the fact that we focus on the asset class of private equity, we look at climate change and climate mitigation as the core the core topic and the core strategy for impact investing. We actually think that you need to be very careful as well about selection here and diversify your exposure to capture the value chain of climate transition and decarbonization of the economy. This starts, with infrastructure. Typically, this is again mentioned earlier as one of the key capital needs, pockets of capital that are going to be needed going forward to fund the transition. And then you can expand this with adding also, traditional buyout, growth capital as well into the sectors that are going to drive this change and drive this transition, but being extremely careful because the overall asset class of impact investing in private equity is still very nascent to a large extent compared to the rest of private equity.
Yeah.
And you have a lot of exposure in emerging markets. You have a lot of
Yeah.
exposure in VC, which are areas that you need to be very careful, in terms of selection.
That's very true. I want to take actually the opportunity to pass the baton to Evelyn. Evelyn, we talk when we met that actually you also do sustainability investing. And I want to read something that you said to me, which I thought it was really interesting. You said, sustainability happens only when you innovate. And you told me that your philosophy is not just to be part of the sustainability conversation, but to contribute substantially to the ongoing journey towards the long-term sustainability. So what do you mean by that?
I'm sure that's somewhere on our website, yeah. No, I believe, what you just said, Pierre, speaks to my heart as well. What you said about, I think what you said about earnings and value creation and that being an area that you can capture in private markets. I would say you can capture it in listed markets as well. It's just as people forgot about doing that. So when you ask me, about what is our angle in sustainability, I said, we capture sustainability by focusing on applied innovation. And the important word there is applied innovation. Applied innovation means stuff that is doable. And a lot of people in the previous panel were also talking about things having to move into real industry.
Yeah.
So I think, my background's in resource and energy investing, where you're also from. And what we learned there is to track cash flows. We track the CapEx and R&D expenses, or actually the CapEx and the OpEx expenses of the majors, and see and analyze the supply chains, right? And we're trying to do that in innovation. And when you do that to innovation, you actually find out where these new technologies and these new innovations actually come to fruition, and where they actually create money and value, and how they also move into industry. And this is, we came from a time, 10 years of interest rates that were low or negative, of inflation that was inexistent. And I think people forgot how to track cash flows and how to look at earnings and how to value companies in that respect anymore. And then we had this phase, this massive, after COVID or during COVID, this spurring of these innovations through even higher kind of risky bets, more TINA. And the theme trade became prevalent, and Giovanni mentioned it as well. Themes came up, and a lot of clients that we speak to now are anti-themes because they've been burnt, right? And we tried blockchain, we tried metaverse, we've done all these themes, and all they did is go up and go bust. So I'm not touching themes anymore. And there were also some sustainability themes that got hammered by that and had people shy away. But I think now the time has come where you can look at these innovations, where they truly are doable, where they can create cash inflows, which are the supply chain providers of these innovations. And you can actually make money by investing in themes. But I think there's just not a lot of us around anymore that know how to select for that. So, the previous panel mentioned the whole thing as well, right? We need to be selective again. And one topic that came up is as well the topic of reshoring.
Yeah.
And when you ask me about sustainability, I will say this is a topic about, not a deglobalization. I think the world will stay global.
Yeah.
But we are moving into a world where companies, and we talk to the large companies that are reshoring, they're not reshoring only for technology certainty, but they're reshoring because they're afraid of not having the stuff they need in their supply chain anymore.
Yes.
And that is a sustainability topic as well.
Absolutely.
And the previous panel also spoke about productivity, inflation being, spurred by these kind of effects, by the climate challenge, by reshoring. And again, I can lean back, I think, because what can solve all these problems? What can solve the climate challenge? What can solve the need for better productivity, for efficiency? It's always going to be innovation, but it's not going to be 10-year out flying cars and 10-year out, AI. It's going to be stuff that's doable today. So you need readily deployable innovation. And I think there's way to discover that, and that's what we concern ourselves with. And that is a sustainability angle that isn't about ESG scores, and it isn't about only investing in private things. It's really about finding the value in the real industry, and there's a listed equity play to be had there.
Indeed, and you don't just do sustainability. Obviously, you invest in many different actually sectors and industries. And so, tell me about what is your investment strategy. Talk to me about a little bit about your funds.
Sure, yeah. Our strategy is supply chain understanding, but the supply chain of innovation. But not just technology as we know it in software and hardware and chips, but actually understanding the full supply chain of industry innovation, material innovation, chemical innovation. Wherever you find innovation, that's what we're looking for. And the reason we do that is to have a leaned back state, right? When a lot of hype topics come around, a lot of people want to chase those hypes. And by looking at where innovation actually applies itself, you're automatically in the area that can grow.
Yeah.
So
just give me an example or two.
Yes. So the investment strategy came from the idea that we probably don't have real growth in the economy anymore. We have cyclical stages, and there's a lot of people concerning themselves with timing the cycle. And we don't want to do that. There are areas that will, in our view, always have growth, and those areas are innovation. Anything that is new, that replaces something old, or that is completely new, penetrates the world, or at least the Western world with a certain extent, is an area that we should focus on. And if you really only concern yourself with that, you're leaving out a hell of a lot of the market that everybody else is trying to figure out. You're not concerned with cycles, you're not concerned with interest rates, and you're not concerned with innovation, inflation. You're actually only concerned with, is there something that is penetrating the market that nobody else can do, or not many other companies can do? Does that thing have pricing power? Or where is the pricing power in that products or services value chain? And, is there a listed company that feeds in the value chain of that product? And so, an example that you asked me about when we spoke were a lot of examples in the mid-cap space, right? So the previous panel was talking about what are the areas that might bounce back next year or going forward. When we look at where innovation is implying itself, it's definitely some of the mega caps that are playing some value there. But when innovation moves into industry, and when the industry is moving towards reshoring or re-identifying their supply chains, you're going to have some industrial companies in the mid-cap space that have been overlooked, or in the materials or chemical space that have been overlooked, that because they offer innovation products and services can actually make a hell of a lot of money as well. So and a company we talked about was Train Technologies. Another one was ATS. There's Landis & Gyr that are doing a lot of the kind of sustainability related innovation. So these are small mid-cap companies that have been, they're not the Mag 7, but they make money with innovative technologies.
And I love it because it's actually very complex, and it takes a lot of actually intelligence to understand the supply chain and how to apply innovation into a very complex, ecosystem. I want to just right now change a little bit gear and go from value creation, sustainable investing in impact investing into absolute return investment. And I want to talk to you, Reto, because you are in this panel very into absolute investing. So tell me a little bit more about your investment strategy and how obviously it differs from what we've been discussing so far.
Yeah. So thank you for that. When we talk a lot about equities and innovation, etc. So what did not come up yet is, you mentioned a bit the credit. I mean, what we do absolute return. We try to not lose much when volatility is here, but at the same time, you need still to achieve a nice return. So you mentioned the private debt, but you find now as a yield back in liquid credit. I think that is certainly an area that needs now more weight and to look at. You can play that in various areas and for a higher or a lower return depending on the risk that you take.
It's clearly about balancing your portfolio. I think you were showing to me like two very interesting graphs when we discussed last week, sorry. Perhaps do you mind to put them through? Because I thought they were really impressive. So I would like to talk about that and also show them to the audience today.
Yes, this is what I meant. I mean, when we talk about the last 10 years and when there was almost no alternative to take a lot of risk to have a large return. So what this graph simply shows you, these are US loans that paid you in the past, let's say 10, 12 years between 4 and 6% on average. You get now paid 10. And there was a lot of debate, okay, where is inflation to end? And there is a worry about the recession that might come, maybe not, but the economy is weakening, right? So the thing is, when you go and you get a yield of 10 as a starting point, and you avoid the defaults, you will end up with a very nice return. So this is just something that has changed. Before it was a discussion also, okay, what can shoot back? Well, this is different. This is different because it's a different starting point.
Yeah. And so how can you take advantage of this rate? So where are those opportunities to invest?
Yeah. So it's one thing is the return, right? So as an active investor, I think also dispersion is also the panel we had before. You need to differentiate, right? Selection cares. It's not only on the equity side that we probably will also hear later on. It is also on the credit. So what is very different when you between an equity and or as a private equity investor, for example, you try to get the next great company, right? So you need to pick the right ones, and otherwise your return will be rather disappointing. On the credit side, you need to avoid the worst, and you do already quite a good job. Not that this is easier, but you need to avoid if you want the worst 10%. So I mean, we have a second chart. If we, I want to illustrate that in this one, and also just. And this is really the message I wanted to place today, is that something has changed. What you see here is, these are European loans, before it was the US. What you see here is the income, is the green bar. And what you see, well, over the last 10 years, you didn't get much, between 3, 4, 5%, but now you get the 10, right? So that's so different. So, and then the worry is always, okay, now the economy is softening. Well, I worry about defaults. The thing is, when you talk about equities, you always talk about the upside, forget maybe a bit the downside. Well, when you talk about credit, everybody gets somehow, well, unease and say, well, there's a lot of risk, you know, there can be defaults. Of course there are, but there's also a huge upside. And this is the change. What you see at the gray bar tells you what this has been the realized loss. In each calendar year. And what you see here, well, yes, there's a negative, but if you have a yield at 10 and you lose, I mean, just to give you an example, I don't know whether you know, maybe in the great financial crisis, the default rate in loans has been 8%. You had 8%, but you had a recovery of 60%. So it means you lost only 40% of 8%. So it is 3.2%. If you don't panic at the very worst time, and you keep your loans, well, you would even have made money in 2008 and 2009. So, but now, as probably nobody fears a great financial crisis ahead of us, but rather default rates normalize, let's say towards, I mean, default rates are now less than 2%, it's about 1.8. Well, we expect they will normalize toward 3 or 4%. So if you have now 4% of defaults and you have a similar recovery rate, let's say, it's even worse. Let's say instead of the 60%, you get only 50 back, and you really hit every default. So you need to be a passive investor. You get all the defaults, 4%, you lose 2, but you have a yield of 10, you end up with 8. That's quite an amazing result when you think about what is the expected return of an equity investor in the long term. Well, probably between 7 at the best, maybe 8, 9% annualized, right? You get that now also here with the yield. So this is really what has changed, and I wanted to highlight this. And even if there are defaults, yes. And now think about if you can select and you avoid the majority of defaults, of course your return will look even better. So I think dispersion, more alpha than beta, but take the beta from credit. It's nice to have the yield. You have that for sure.
So how do you get access to these trades?
I mean, there are two ways. You can do the more liquid way. I mean, you can buy a loan fund. You can, hopefully you buy the right one. You need to be selective there. You can mix it up with other credit strategies. That is what we do all day long. That's the liquid format. And then we can also say, well, how is that when you do it more in what we also do in hedge funds, credit long short? I think it's one of the most appealing strategies. You mentioned distressed debt. I'm certainly also in the camp of that, but less so the deep distress, because I think there will be not as many defaults as many think. So there will be a scarce of opportunities and everybody's hunting the same. So I love a bit more the type of stressed credit. So it means not the deep distress stories, but rather the bond that trades down to 80 and to try to buy the right one there.
Is it possible to have like a couple of examples of specific trades that you have been very interested in looking and trading?
Yes.
In the past few.
Yes,
recently?
absolutely. I think the trade example I like the most is really what you have seen now after pandemic, that you have seen supply chain issues, right? So many companies have had their problems. Now you have many companies, they have the problems because of the increase in capital costs that you have. And it's now very key that you can differentiate, well, is it an issue of the business model? Or is it something that is more temporary an issue? Or can you address your debt burden? Maybe you inject more equity, so it's not to the advantage of the private equity investor because he needs to bring in more equity, but it's to the advantage of the debt investor. So what you see in these companies, if you see, well, this company has a sound business model, the issue is just temporary. So the bond trades down to 70 cents. You have a coupon of 7. Well, 7 divided by 70, you have a yield of 10. And if you think, well, the business model is sound, the company will come back in 1, 2, 3 years. Well, if you buy the bond at 70 and the bond should pay back at 100, well, you have an upside of 50. So you have a coupon of 10. In addition, you have the upside of 50. So that's normally as a bond investor, you have a negative convexity because you buy something, you get the coupon at 100. Well, you can lose everything, but you get only the coupon of 7. But nowadays, you get the 10 and you have an upside on top of it of 50%. So this is the thing as a long-only investor, as a stressed investor. And the second example would then be, well, as a credit long-short investor, you say, well, I'm able to identify also the business models they will not sustain. Then you buy the longs. Hopefully you do that right, well, diversified, and then you buy not the bond when you believe it's a bad business model. You short it. Well, then the bond can trade down from 70 to 50 or whatever. And that's also positive. So you collect on both sides attractive yield, and you will be positioned very well if the economy is softening next year.
So when you are selecting a fund to invest to, a bond to invest to, what are the criteria looking at to make it successful?
Yeah, I don't want to make it too long here. It is really about the business model, right? You want to understand, is it sustainable? So will you get the money back and do you have the upside? In addition, if something goes wrong, you won't make sure you're senior secured. So if something goes wrong, then you own the asset, or you even might get the equity and you own the company.
That's really fascinating. So we're going from sustainability to private equity, private markets to supply chain, and then we go back into absolute investing. I want to change gear again, sorry. I want to talk to you, Alex, because you have a really interesting business model. And when we actually met the first time, we're talking about how you came up with this idea. And please tell me a little bit more about your inspiration with Warren Buffett then.
Thanks a lot to be here, first of all. I mean, I had the chance 21 years ago to do an executive MBA with the Swiss Finance Institute. And there I had a huge pile of paper with 180 hours pre-reading. Among that was this book called Strategic Logic from a Spaniard called Professor José Carlos Jarillo, who has been doing his PhD in Harvard more than 35 years ago, and then was co-writer of Harvard Cases. And when I was reading through this book, he never taught finance. He actually taught how can it be that the company A can be more profitable than the company B. And this book is a case study book, which is very, very interesting because I used to be a fund manager at UBS for 35 years ago for Eastern European equities. So I visited Bulgaria and countries like that. Very interesting. But when I was reading this book, it's a case study book. There was a case in 2001 written how stupid it was from Daimler to buy Chrysler. And of course, I had the same impression. A lot of financial analysts at that time were applauding it because they wanted to be part of the next deal or of this deal. I had a different opinion, and I had a fixed idea then to convince my future professor who was teaching us on the third day, why don't we start a fund together? Because I think I know how to value companies, and if you add his lenses, looking at competitive landscape, that can add a lot of value. And I think that's very interesting. And we heard it before, go back to the basics. I was also very interested to see your votes on value investing.
That was very interesting too.
I was scared that
I was not expecting that.
But I was extremely happy that it was as low as it was because I want to show you some slides.
Can you actually, before you show the slide, sorry, can we go back to the voting? That would be really interesting to go back into what is actually really interesting for this panel today, for this audience today.
Exactly.
The one that we did at the beginning when we saw the results of the voting. So what do people care about today? If we still have it.
It's already yesterday, so it doesn't matter anymore.
There you go. So Alex, you were shocked about this, right?
No, I was actually happy.
Oh, good.
I was afraid that, okay, if 90% of you would like to have values investing, then I would say, okay, then it's end of the party. But I'm very happy that only one person said it's interesting.
It's probably you.
I was not even voting. I think I know who voted. My friend who is also a value investor. But if you want to go now to the other chart. Yeah, if you just enlarge it and then go to the first, or actually you can jump to the second slide. Because the first chart, sorry, once back, maybe it's still. Here you see the very long trend since the Second World War. The normal scenario is that value performs pretty well. Now, of course, we could have a debate for hours, value against growth, blah, blah, blah. Let's not go into that. There it says growth blip. Now, of course, the next slide is really magnifying the last couple of years because it's too easy to say value is always better, you know? So if you go to the next slide, please, you see that it was a terrible time for value. And I know now why only one guy or one lady wanted to vote for value and thinks it's interesting. But to me, such a chart makes me massively interested. If you look at the year 2000 and where we have been now, in another chart I calculated myself, we were at 5 standard deviation in the ratio. 5 standard deviation in the insurance world or the reinsurance world means an event that occurs only once every 4,000 years. Okay, COVID, etc., and you see it really how massively it went against it. It went so massively against it that my partner, my former professor, in 19, when he got 65, wanted to sell the company because he was frustrated that he was actually thinking value will never come back. And the older you get, the more you know that history repeats itself again and again. And if you look at the next chart, which is another chart, which is interesting, These are commodity prices measured in equities. I mean, I think you should go back to the basics. The next slide. These are mining stocks relative to MSCI World. And we have a strong belief and conviction, I would say, that we are in a repetition phase like 2001 to 2007-8, because of a lack of investment. The last 10 years, everybody was invested in fancy things. I heard it from some venture capital guys in the US. There was a saying, you could throw a stone through a hole and get money for it. Yeah, I think maybe brick walls could be an interesting business. We have been invested in Wienerberger. Nobody knows it any longer, but Wienerberger is the largest European brick producer, and we were able to buy a couple of years back for 0.06 price to book. And the next chart, that's even more shocking. Here you see that this ratio really fell down the cliff. And Evelyn, who used to be a fund manager for energy, the large companies, they gave up to believe that is ever needed, because we all think and are convinced that by 25, we don't need oil any longer. I could tell you the math that the world has not enough copper to electrify 10% of the global car fleet, which is 1.4 billion cars. And by the way, driving around with our private cars is only 20% of the oil demand. So if we could have this 10% electrified, we would save 2% of oil demand by 2030, which is not going to be the case. Because you then realize real problems, because there is a cable missing. Everybody wants to drive back from Laax and Davos and Lanzerheide in the winter. And you have maybe an accident there, and you are sitting in an electrical car, and then suddenly 1 or 2 electrical cars are standing there. But if all the cars are electric, welcome to the new world. You're going to freeze in your car.
So with you here, we go into going back to basic, going back to common sense, and also, as you were suggesting before, going back to the beginning of the meaning of private equity. So how basically you build your investment strategy? What is in the future?
We call our style in strategic value, not only value, so it's going really to the book. So we are very much interested in niche markets. A crazy example, I don't know of how many of you have heard on the sausage skin market. There are 3 players in the world that produce to a large scale industrial sausage skins. The third one being Chinese. Now we owned out of 35 names, December 19, the 2 of them that were not Chinese, controlling 65% of the global sausage skin market. Why is it so interesting? Okay, I mean, my professor says, okay, oligopolistic, it's already interesting. But the second very important point is small ticket items. Because the buyer of the sausage skin just pays 2% for the skin relative to the total production cost. He's not sensitive in price, because the cleanup costs are much, much higher than to pay the sausage skin provider a bit more. These are extremely interesting businesses. And you know, the world has become ETF, meaning passive, and the world is influenced by things like MiFID, where we have a research budget, which leads to the fact that the small mid-cap companies are not covered and followed anymore, which is, for somebody that can do his own math, a paradox. So being selective, or try to be more and more selective.
When we spoke last time, also, you said something really interesting that struck to me. You said that basically from the years 2011, 2019, have been really interesting, to say the least. Exactly, because money was too cheap and stock price went to the roof. So what did you learn in those years, and how has this shaped your investment strategy?
I mean, what was very important for us when we started in 2002, it was the perfect star constellation to start with a value fund. Because we were beating 6.5 years MSCI World by 20%. We went from 5 million to 2 billion, and we were the stars interviewed in the Barron's magazine over 3 pages, etc., etc. And then came the financial crisis. And we were outperforming that much because my partner wanted to build a portfolio out of cigar butts, as Warren Buffett called it, really the deep, deep value stocks. And that's great when the economy is going well, but it's terrible if the economy has a heart attack, as it has in the financial crisis. So since 2011, we then decided this volatility that we had in the past, nobody can handle. We need to basically do what Warren Buffett learned from Charlie Munger, to say, okay, let's put half of the portfolio still in cigar butts, but the other half, we want to pay a bit more. Don't be too greedy all the time, but we get stability. And this stability mechanism, or you can call it rebalancing possibility, is fantastic. So I would advise everybody of you two things. You should do the same as I do for my kids. I get 230 Swiss franc kids allowance. I put it in the fund every month. Forget about timing, because equities, maybe I'm not objective, but equities are a good investment on the long run for sure. I had to fight with the UBS to get only equities for my newborn baby, which was crazy because they said, yeah, what is his risk tolerance? I mean, so far about big organization and the rules. I mean, who has a longer time horizon than a newborn? So, I mean, that is one message. And the other message is try to be in the position where you can rebalance.
Yeah.
Because, you know, when we were in a 2008 scenario and we were with the back against the wall, you would love to buy everything, but you cannot. But if you have something else, then you can sell that and rebalance it in the other stuff. And that would be my advice for everybody, also PA. Try to have different eggs in the bucket. Like Warren Buffett said, you should at least have 6 or 8 eggs in your basket. And then try to rebalance. Because on the long run, there are these long-term cycles that go up and down all the time. And the older you get, the more clear it is.
I love this panel. It's so diverse, and actually would love to go from, again, one extreme to the next and move to you, Sebastian, because you actually are investing in digital asset. And you told me lots of debt and people want to hedge. Before it was with gold, and now it's through Bitcoin. Please tell us more.
Yeah, so thanks for having me, first of all. And we have heard a lot of about being selective and choosing the right companies, having an upside when also looking at the risk. I'm representing a little bit the different side, the more risky assets, as you would call them. And we also have seen a lot of cycles in that asset class already, because it has been around for some time. We also heard already that, of course, some people lost faith in that asset class. You know, there was a very bad time for some time. You know, it was hard to get funding for such companies, etc. But there was also a necessary cleansing, so to say, right? So bad players went out, quality stayed in, because now to sustain in that market, you need to make cash flows and you need to stick to quality. And the two main quality assets that we have in digital assets is Bitcoin, of course, and Ethereum. Bitcoin, it is always been treated as a digital gold. There's a scarcity, 21 million coins. There's no additional coins ever created. So we only have that amount, and there are smart contracts in play that reduce incentives to mine the coins. Can say a bit more about that a bit later. The halving, which we will have in April next year. And then we have Ethereum, which is more the future bet into the world of Web3, because it's basically the oil that makes the whole machine function. You have the whole NFT platforms based on it. You have a lot of trading based on it. So all the use cases that you already have in crypto and digital assets, they are based on Ethereum.
So what's happening right now in the NFT world?
It's a good question, because not my specialty, I have to say. But what we've seen in the NFT space is we have seen the initial hype when they first came into play. That was in the end of 2021. That was a very early stages. Then we have seen more players coming in. We have seen incredible prices, right? Let's say 150,000 US dollars for a small JPEG of an ape. You know, we had those outrageous prices. But then what we also saw, what was way more interesting, I think, is traditional companies coming in and trying to figure out what this new innovation could mean and trying to learn how to apply it in a sensible way. And I think that's very important, because in innovation, you always try new stuff. Not everything works out, and that's a good thing. But we also learn something, how to engage with customers, for example, in a new way. And we've seen a lot of traditional companies do that. For example, Ferrari, Gucci, Louis Vuitton, you name it. Also luxury companies want to engage with the customer in a more long-term way and want to get them closer to the brand, also Rolex, I'm sure. And there are also other use cases, of course. So there's a customer retention. You have a lot of companies exploring NFTs in a real estate sense. I can't really talk to that much, but I know there's a lot of development going on. And I had a brief chat earlier today where I said, whoever bought a property already, real estate, knows how manual and analog that process is. It's very paper driven, at least in the countries where I saw it, which is Germany and Denmark. And I feel that process is ripe for some innovation, you know, and NFT could maybe play a part in that, because you can transfer a value through an NFT and will never be able to be changed. We see that to a smaller scale. For example, I mentioned luxury brand watches, and they then replicate your certificate of your watch on the blockchain. And once you want to sell the watch, which might happen, you can just move the certificate and will always represent the true owners. So those are just some of the use cases. There are a lot, but yeah.
And I wanted to deep dive on your investment strategy. I think you have something to show us as well tonight, don't you?
Yeah, let's have a brief look at the slides. Right, the next one, please. Yeah, let's stay here for a moment. So at the moment, I mean, we already as a company have been in digital assets way longer, but the question is why is it interesting? Why is it still interesting? Why should you still be concerned with it, despite all that hype and ups and downs? But I think right now, as you can see, you have 3 catalysts that come into play. You have the user adoption, you have a lot of private and institutional investors coming back into the asset class, because after all that hype and the cleansing, what remains is basically quality companies, not all of them, of course, but you still see a lot of good use cases that are worth investing in. And people realize that, and also the technology has been around for some time. So all the early kings have been ironed out to a degree. So now what really makes a difference is really applying it in real life. As you can see with a lot of hype cycles, you always see the initial hype going up and people basically selling promises. Not a lot of these promises hold up. And later on, then you see a maturing to real world application. And that's the phase that we are in with crypto now. You see a lot of big companies moving in. I saw the other day that JP Morgan, and through their own coin, facilitates transactions in the scale of $1 billion every day through their own digital token. Might not sound like a lot in the grand scheme of things, but you have a lot of these smaller stories connecting to a bigger picture.
Indeed.
Which is why it's a good time to invest.
And actually, you were telling me that the regulation is also coming to play a very positive role for digital currency right now. Can you tell us a little bit more?
You know, exactly. If we can go to the next slide, you see it here on the very one bank. Okay, then it's 2 slides more. So yeah, there it is on the very left. So I mean, regulation in crypto always has been a little bit of difficult story in a way, because in the beginning everybody saw Bitcoin and digital assets also as a different side to the traditional banking system. But what people realized over time, that it can't be opposing the traditional banking system and the regulators, but has to work with them. Otherwise, we are not going to get anywhere anytime soon. And that's exactly what happened in places that have embraced it, like Europe, the Middle East. We see it in Asia. So yes, it's a bit tricky, just because the SEC fights their own fight against crypto.
Yeah.
So I would love to see some more applicable regulation out of the US, but unfortunately, it's not going to happen anytime soon, just because politically the country is a bit divided, right? You have the elections coming off, and you would need both political parties to make these big laws happen. So I don't expect too much out of the US anytime soon. But what we see here in Europe, and Switzerland also has a very positive regulatory framework, we see stable frameworks that are necessary to give the security and the trust back to those investors, because what those frameworks provide is basically standards and security. And those standards are quite, complex and demanding. So it's not something that you can easily do. So I think it will also be a catalyst for people to trust the whole space a bit
So
more.
what's going to be ahead in your investment strategy? What's happening at Norstake?
Yeah, so we provide the entry point for digital assets. We help companies to either invest in digital assets, and how you do that in a capital efficient way is through staking, because then you get both the upside in the underlying asset and the staking yield. For those who don't know, very briefly, staking is a reward that you get when you secure the network of the blockchain. It's kind of, you can imagine it like a dividend of the token of the protocol, and you get that on a daily basis. Can also be on a monthly basis, but usually it's daily. And that's around 4%. Doesn't sound like a lot, and it's not, but the upside of the underlying token is already quite significant. We have seen year-to-date developments of around 70% for Ethereum, for example. So you see these positive developments happening, but of course I still urge everybody to look at each investment, do their own research, and only choose quality investments. And we can help with that. We are not a financial advisor, but we provide the basic to invest in digital assets and then stake them securely and regulatory compliant with us. And we also offer OTC trading for institutional investors or private individuals that want to buy larger quantities.
I know we are running out of time, but we actually have started also late, but I want to make sure that we actually give the opportunity to ask 2 questions at least. So I open the question to the floor. Anybody can ask any question to any of the panelists here, also to multiple panelists. So please, let's start. Has anybody got the mic to pass on? Okay, we got this one. Shall I do it then? Okay. Anybody wants to ask a question? One question? No question? Okay. Well, we have a question over there. The lady in the back. Is it open, this mic? Yeah, thank you. Thank you. Who is your question to?
Actually, to the whole panel. So good evening, everybody. Thank you very much for this insightful discussion. My background is in digital experience design, so it's going to be a bit generalist. So I would like to know in which way you can quantify end customers' perception of, for example, digital products, to understand in which way your product may be more interested for them or not, or in which way volatility may influence potential trends into investments that your customers may make. Thank you.
Who would like to say the question first? Is the question clear? Shall we rephrase it again?
Yeah.
Yeah. Thank you.
So yeah, so the idea is essentially in which way people's perception or end customers' perception of, let's say, how regulated the market is in terms of digital assets, or what type of risks there may be if they invest their money on certain type of, let's say, NFTs, how secure they are. How do you incorporate this into the assessment of the potential of certain investment portfolios that you may have?
So I guess probably maybe Sebastian, you could take the question. So how is the perception of investors about the regulatory environment, and how basically this is impacting the decision for invest?
Right.
Sorry for the back.
And also some part of it was about the risks
Indeed.
associated. I mean, how we work in Norstake, when we onboard people, it's usually a two-way process, just because we also want to demonstrate that the associated risks with our company, but the market as a whole, are manageable for that person and are within their risk horizon. So we have several ways of doing that. First of all, we go through several audits to just show the strengths of the company. Then we explain the underlying risks of the assets. We show how secure our infrastructure is, and just to give that person the right level of trust and understanding. And then we, of course, provide our own due diligence on the customer itself.
As it answered your question? Okay.
Was that the right direction or?
Yeah.
Okay.
Sorry, I should have stayed there. My bad.
So actually, my background is in risk perception, and that's why I'm so asking the question, and specifically in technology and innovation perception. So, and how that influences people into adopting the technology and then keeping using it. So I appreciate your response, because essentially it's one way to manage risk perception or governance around it is to strengthen on the securities that you have, and essentially what is the strength of your organization. But I think it would be interesting to see in the long term how that plays if end customers are actually perceive that their investments are being secure, or in the long term they're actually responding to their needs. But thank you very much for the answer today.
That's a very interesting angle. Thank you so much for asking the question. Any other question here, or would you like to have questions directly? This lady here on the front row, please.
Good evening together, Katrin Jarian. Thank you very much. It's delightful to follow your conversation from here. My question is quite simple, 20 million now. How would you invest? How would you diversify, to the man with the EMBA and the holding the book up?
Alex,
simple question here at the final round before the buffet, right?
Thank you.
Thank you.
I'm absolutely convinced that value and natural resources are an interesting subject for the next 10 years, but I think there are some other very good ideas also here. And I would think it's for sure worth checking.
Any other question? Okay, so in that case, I want to.
There was one more.
Oh, sorry. Which one? Oh, I'm sorry. I didn't see you. The mic is yours.
I was
Please-
hiding in
please
the
come
back,
here.
sorry. I guess this is more a general panel question, but Pierre, you were talking briefly about the denominator effect and that institutionals have to sort of lower their allocation into private markets. How do they balance that with sort of a mandate of investing sustainably now, where a lot of that is existing in private markets? So where do they find that balance, especially on the institutional level?
So
I'm sorry, we are short of mics today, but it tells my step counts. Okay.
Thank you. So I think all investors are very different and have very different levels of risk profile, time horizon when it comes to overall asset allocation, including allocation to private markets. We deal mostly with wealth management and private clients. So of course, this is an investor base which is under allocating into the asset class. There is a lot of potential to catch up. If we look at the Julius Baer today, our client base is roughly allocating around 1 to 2% into private markets. If you compare this with what an institutional pension fund or an insurance company might be doing, these are two very different worlds. So there are still pockets of wealth and assets which can still deploy substantial amounts of money into the asset class. But I would say that the denominator effect is unfortunately here to stay, and it will depend a lot on the asset price expansion and the dynamics at play.
Right, at this point, I think we have to basically end the conversation here, but please do continue with your question with our panelists and everybody here in the networking event, because unfortunately we have only 1 hour to network, so that's very important that we continue. I want to say thank you to the wonderful panelists here, and also the panelists in panel 1, and I thank you all of you for being here and to make this happen. Thank you to the Samba team, and also to Ginetta for having us here. And also thank you for the wonderful people at home or at the office that are actually watching us right now live. So we will see you shortly, and please do come to the next event. They are already on the website, and enjoy the networking evening. Thank you.
Thank you.
Right.
I was saying, take a picture because I get the picture before the pictures.
Yeah. So the thing is, I always get the feel that everybody lose sanity.
Right, yeah.
It's quite difficult. So, okay, thank you very much. Thank you.
How are you? The first I always felt like I don't. That's yours. Thank you so much. Yeah, I see. Let's find it here.